We now come to section 2.4, which is very important from a testability point of view: disclosures of pension and other post-employment benefits. This is a high-level slide, and then over the next few slides we'll go over each of these bullet points. When comparing different companies, you need to keep the following in mind. Different companies will probably be using somewhat different assumptions. The discount rate assumption might be different. The assumption about changes in salaries might be different. The amounts disclosed in the balance sheet are net amounts. This is another point that you keep in mind, and we'll talk about how to deal with this. What is meant here? The fact that what is reported is either the net asset or the net liability. Then pension periodic costs are recognized in the P&L, but the numbers might not be comparable, and we'll talk about this. Reporting of pension costs in P&L may not be comparable. So the third bullet talks about recognition. The fourth bullet talks about where numbers are reported. And then finally, we might need to make some adjustments to cash flow statements. So let's go over each of these. We'll start with the first one, which had to do with assumptions. The first big assumption has to do with the discount rate. Generally, companies use the discount rate associated with high quality corporate bonds. So if you are in an economy where the expected return on high quality corporate bonds is 3%, then that is the return that is used to discount future cash flows. Are the assumptions internally consistent? So this is something you as an analyst need to look at. Note that there is a discount rate assumption, and then there are also assumptions about the rate at which salaries will go up. Now both these rates, the discount rate and the rate at which salary goes up, obviously depend on inflation, right? Now, what you as an analyst need to verify is that the company is making a consistent assumption about inflation when coming up with these two rates. Because if a company is trying to manipulate numbers, it will have an incentive to overstate the discount rate. In other words, assume a relatively high inflation. And a company will have an incentive to understate the rate at which salaries are going up. So if you look at the numbers, and over here the company is assuming a high inflation rate, and over here with the salary increases the company is assuming a low inflation rate, that means that the assumptions are not internally consistent, and that would be a red flag. Next point is expected return on planned assets. This is relevant for US GAAP only. You as an analyst need to understand whether that expected return is reasonable or not. Companies with post-employment healthcare plans disclose assumptions about increases in healthcare costs. This falls in the other post-employment benefits category. One of the most significant benefits other than regular pension is healthcare benefits. If you are committing to your employees that you are providing healthcare benefits, obviously you need to make an assumption about the cost of healthcare. Healthcare costs tend to go up quite a bit. So you then have to make an assumption about the rate at which healthcare costs go up. And that's the point made over here. Healthcare costs, generally speaking, go up at a relatively fast rate for a certain period of time and then taper off at a lower rate. Holding all else equal, each of the following assumptions would result in higher obligation and higher periodic costs. We are still talking about healthcare costs here. A higher assumed near-term increase in healthcare costs. If you are comparing two companies and one assumes that healthcare costs go up at 9% over the next 5 years, and another company assumes that healthcare costs will go up at 7% over the same period, then you need to be careful, because simply by making a different assumption, they are changing the value of the pension obligation. Also, there is this assumption about the healthcare cost in the long run. There is an assumption about when we switch from short run to long run. So you need to compare the assumptions that different companies make. And this is illustrated in example 4, where you are given two companies, CNH and Caterpillar. I am highlighting an aspect of this example. I'm not going to go through the whole example in detail, but here is a basic question for you. If you are looking at these numbers, the initial healthcare trend rate, this is saying that for CNH, the assumption is that healthcare cost will go up at 9% till 2017, and Caterpillar is assuming an increase in cost of 7% per year till 2016, and both companies are assuming that ultimately healthcare cost will go up at 5%. This is now testing your basic concept. Which company, CNH or Caterpillar, which company's assumptions about healthcare costs appear less conservative? When you see less conservative, you can also see this as more aggressive. The correct answer here is Caterpillar. Generally, American companies tend to be more aggressive, but you can't use that on the exam. You need to actually look at the numbers. So Caterpillar is assuming an increase of 7% initially, which means that it is assuming that healthcare costs are going up slowly, which means that the present value of the obligation will be lower. So it's reporting a lower liability relative to the other company. What if you were just looking at these numbers? So where will the trend come down to a lower rate? Here again, Caterpillar is assuming that the trend will end sooner. This is also a more aggressive assumption, as opposed to the other company, which is assuming the higher rate for a longer period. So on both counts, 2 out of 3 counts, Caterpillar is more aggressive. On this count, they are the same. Then the next question is something just you can look at a high level. I don't think you need to get too hung up with the calculations. What would be the effect of adjusting the post-employment benefit obligation and the periodic post-employment benefit expense of the less conservative company, this would be Caterpillar, for a 1-point increase in healthcare cost trends? Does this make the two companies more comparable? So what we are now saying is that if there is a 1% point increase, so from 7% we assume a 8% growth rate for the less conservative company, which is the more aggressive company, does it make it easier to compare with the other company? We are moving in the right direction. Ideally, they should go up by 2%. But notice that as we increase the rate from 7% to 8%, what is happening to the obligation? The obligation is increasing by 220 million. The expense is also increasing. So just keep that in mind. And then what would be the change in each company's 2009 ratio of debt to equity, assuming a 1% increase? Here again, the calculations are done for you, but you can see that the debt to equity ratio actually goes up. Why does the ratio go up? Because if you are assuming that costs are going up at a higher rate, that means the present value of the obligation, which is debt, that is going up. And essentially equity is not impacted, so relatively speaking. So your ratio of debt to equity is getting worse. Net pension liability and total periodic pension cost. Now this is straightforward but important. When we report numbers on the balance sheet, we are reporting a net number. It's either a net liability or a net asset, and obviously we are talking about pension. Under both IFRS and US GAAP standards, the amount disclosed in the balance sheet is a net amount. But if you think about it, let us take a very simple company which has assets equal to 100. This is the balance sheet reporting. So let's say we have assets equal to 100. Let's say that liabilities are effectively 0. Let's say the pension plan is fully funded in the sense that plan assets equals the pension obligation. So this number is the same. What will we report on the balance sheet? The net plan asset or liability will be 0. So this particular company will have asset equal to 100, equity equal to 100. Does this company look really good in terms of the level of debt? It does. The leverage ratio is, infinite, just to take an extreme scenario. But let's say that this company has a huge pension obligation. Let's say that the pension obligation is equal to 200 and the plan asset is also equal to 200. What is reported on the balance sheet for the pension? 0. But if we actually take the full numbers into account, then what is happening to the asset number? The asset is then actually increasing by 200 to 300. What is happening to the liability number? The liability number is now 200 and overall equity is obviously has to be the same, right? So what is the point here? The point is that just taking the net number for the pension obligation can at times be misleading, especially if you are calculating leverage ratios and so on. So it is better that you take the full amount. So it is referred to as the gross amount when you are coming up with your debt to equity ratios. That will give you a better indication of the level of obligation of the company. What about the next point? We've touched on this before. Total periodic pension costs. The total periodic pension cost of a company's defined benefit pension plan is the change in the net pension liability or asset, excluding the effect of the employer's periodic contribution into the plan. We've talked about this before. Now, when the curriculum talks about cost over here, it is talking about overall cost, which is allocated both to the income statement and the OCI part of equity. Here the curriculum gives a straightforward example but also creates a small confusion, which I will talk about. But as long as you understand the main concept, then hopefully there will be no confusion. Over a given period, let's say that the net pension liability or the net liability is 0. And then at the end of the period, the net liability goes up to 500. Then what is the pension cost? It is the change in liability. So we can say the pension cost is 500. Now take another situation where over this period, let's say the net liability is 0 initially. There is a contribution equal to 500 and the net liability is still 0 at the end. What is the pension cost over here? The pension cost is clearly 500. So it is the change in liability adjusted for the contribution. So you add the contribution. Now I have used the convention here that the funded status is a liability. When I use that assumption, then the formula is that the periodic cost is ending funding status minus funding status plus employer contribution. If you look at this particular segment in the curriculum, instead of saying plus, they say minus. And then in the footnote, they point out that the funding status, I'll actually read the exact terminology or the exact footnote in the curriculum. The curriculum says that note that a pension liability is treated as a negative funding status in this relationship, the relationship where they use a minus. And again, I'll emphasize that you should understand the concept. If you want to just stick to one scenario, then stick to the scenario where the funding status is a net liability, and then the formula will have a plus. Okay, now here is another important table from the curriculum. This actually is shown earlier in the curriculum, but I thought it's more relevant over here. Periodic pension costs recognized in P&L versus OCI. This part of the table I've actually shown you before. the part in bluish color is showing the IFRS treatment which we've talked about. The pension cost has three components: service cost, the net interest income and expense, and then the third item is remeasurements. And I'll go over this again because it's important. So the service cost is recognized in the P&L, and this has to do with the cost associated with the service performed in a given period. Then the net interest income or expense, this is also recognized in the P&L as the following amount: the net pension liability or asset multiplied by interest rate. If you have a net pension liability, then this would be a cost. If you have a net pension asset, then this would be income. And then with remeasurements, all remeasurements according to IFRS are shown in OCI. There are two subcategories under remeasurements. One is called net return on plan assets, which is equal to actual return minus this number, plan assets into interest rate. And I've gone over this before. I'm just repeating because this is important. The other subcomponent under remeasurements is actuarial gains and losses, which is changes in a company's pension obligation arising from changes in actuarial assumptions. On the right, we look at US GAAP treatment, and this will be important if you have a question that deals with the difference between US GAAP and IFRS. The first difference that you will note is that under US GAAP, service costs are broken into two parts: current service costs and past service costs. Current service costs refer to the amount by which pension obligation increases as a result of employees' service in the current period. Past service costs refers to the amount by which pension obligation relating to employees' service in prior periods changes as a result of plan amendments or plan curtailments. If you recall, when we talked about example 2 in the curriculum, there were different scenarios. One scenario was the employee started getting a benefit based on time worked. In scenario 2 and 4, we had a situation where there was an initial obligation. If we start out with an obligation and then over this period, let's say that the company changes the formula and the company now says that instead of paying you 1.5%, we'll pay 1.6%. Is there going to be a change in the pension obligation? There is, and that is referred to as the past service cost. So I'll just read this again. The amount by which the pension obligation relating to employees' services in prior periods changes as a result of plan amendments or plan curtailments made in a particular period. Now, to be very honest, I think you need to know this at a high level because the focus of this reading is IFRS. And as a side little remark, if you carefully go through this reading, it is written in British English as opposed to American English. So a subtle indication of the globalization of the CFA Institute. So I think you need to know this at a high level. Trying to get too much into detail is probably not worth it as long as you understand the distinction. The second item under US GAAP, or the second component, is given right here: interest expense on pension obligation and expected return on plan assets. Note that this particular item is broken into two parts in US GAAP, whereas under IFRS we just take one number where we take the net pension liability or the net asset and multiply by the discount rate. Here this is broken into two parts. There is the interest expense on pension obligation. Where is this coming from? This is taking the actual value of the pension obligation, not the net value, and multiplying by the discount rate or the interest rate. And then you separately take the expected return on plan assets. So in US GAAP, two numbers are defined: the discount rate, which you use to discount, and the expected return on plan assets, which is giving you the expected return on plan assets exactly the way it is stated. So that's a subtle distinction. The first part is recognized in P&L. and the second part is also recognized in P&L as this amount. So both these numbers are shown in the P&L. So from analysis perspective, if a company changes this assumption, and we talked about this before, if the company starts assuming that the return on plan assets is higher, what will that do to the income statement? That will make the income statement look better, because we are then showing a higher income. So if a company makes a small assumption change that our plan asset will give us 7.9% as opposed to 7.8%, that can be used to manipulate earnings. What about the third category? Under US GAAP, the third category is actuarial gains and losses, which includes differences between actual and expected return on plan assets. There are two different approaches over here. One is that these gains are recognized immediately in P&L, or the other approach, which is more common for US GAAP companies, is to recognize in OCI and subsequently amortize to the P&L using the corridor or faster recognition method. Now, I don't think you need to get into the details of these methods. They are explained in the footnotes in the curriculum, but just recognize that if numbers are put in OCI, then there is a method based on which these numbers flow from OCI to the P&L, and one of those methods is called the corridor method, the other is called the faster recognition method. Two other final points here. The difference between expected and actual return on assets is equal to the actual return minus plan assets into expected return. This is somewhat similar to what we saw here, but there is a difference. Remember, here we subtracted plan assets into the interest rate because in IFRS we just use that interest rate term. But under US GAAP, we subtract plan assets into expected return because expected return is the rate associated with the plan assets. Actuarial gains and losses is a change in company's pension obligation arising from changes in actuarial assumptions. Now, next point. Classification of periodic pension costs recognized in the P&L. This is also important from a testability perspective. Pension costs are shown as operating expenses. However, the interest component and asset returns are not really operating expenses. The interest component should be a finance cost, and the asset return is not really an operating revenue. It should be shown as a non-operating revenue. So what are the adjustments that should be made? Only the service cost really should be shown as an operating expense. The interest expense or the interest component of your pension cost should be shown as part of the company's interest expense, and the return on plan assets is a return, but it's not an operating return, so it should be shown as a non-operating income. Now, here is a very simple example that I came up with. Let's say that a company which follows US GAAP has this particular income statement. You are given the revenue, you are given operating expenses, EBIT is 40, you are given the interest expense, the interest income is 0 initially, and the profit before tax is 50, the simplest income statement you will ever see. Now, in addition to this, there is a pension disclosure. The pension disclosure is that the current service cost is 5. This is in brackets, so that means it's a cost. The interest cost is 2. You are also told that since this is a US GAAP company, the expected return on plan assets is 6, and the actual return over a given period was 8. So the first question is, what is the profit before tax if actual rather than expected return on plan assets is used? Remember, in US GAAP, to come up with the profit, what return did we use, the expected or the actual? In US GAAP, we use expected. All right, so what is the adjustment? The expected return was 6, the actual was 8. So we are talking before tax here. Will PBT, and I'll make this in a CFA exam format, stay the same, increase to 52, or go down to 48?
52.
The answer is it will go up, because when you make the adjustment and you take the actual return, then that actual return is higher. This was the easy one. The slightly more complicated question is this one. Adjust the individual line items on the company's income statement to reclassify the components of the pension and other post-retirement benefit expenses. In this case, we are just looking at pension. We need to classify this as operating, interest expense, and interest income. So what do we do here? How does the operating expense change? Currently, operating expense is 40. Are we including this entire amount of 7 over here? All right. So the point is you only want the impact of 5, not the 2. So this should become an expense of 38 because you are rolling back 7 and then only including 5. What have we done by coming to 38? We have backed out the interest cost. Then what happens to the interest expense? The interest expense will then go from 10 to 12. Does this make sense? It does. And what does this change? If you are looking at EBIT, if you are looking at operating profit margins, it makes sense to do this adjustment. What about the interest income? What is the impact there? So notice that there will be a benefit of 2. So where do you want to show that? That benefit of 2, you want to show that in interest income. What you need to do now, and we'll make the video available for this, is example 5, which is a more complicated version of the same point. We'll now look at the cash flow information, and we'll understand the concept here through a very simple scenario. Let's say that during a given period, the pension cost is 100 and a company contribution is 120. Let's also say that the pension obligation, which is a liability, initially is 500. Now, under standard accounting rules, when a company makes a contribution, this 120 is classified as a cash flow from operations. So this 120 would reduce the CFO of a company. But if you think about it, if a company is contributing more than the pension cost, that differential of 20 is really financing. It is reducing the pension obligation. So out of this 120, on a before tax basis, 100 should be shown in the CFO category and 20 should be shown in the CFF category. If we look at numbers on an after-tax basis, so what is the after-tax amount by which the company's contribution exceeds pension cost? Then all we do is look at the difference of 120 and 100, which is 20, multiply that by 1 minus the tax rate, which is 0.75, so you will get 15. So on an after-tax basis, the impact is 15. Now if we connect back to our scenario, let's say over this period, before adjustment, the reported CFO is 300. In this reported CFO, the entire amount was shown as an operating outflow. But we've just established that that entire amount ideally should not be shown as operating. Some of it should be put in the CFF bucket. How much? On an after-tax basis, 15. So after adjustment, the CFO should go up to 315. The inflow, remember CFO is given as an inflow, so we have a higher inflow. The CFF, the financing part, is an outflow of 200. Since we are putting that extra 15 over here, the outflow will go up from 200 to 15. The outflow will go up from 200 to 215. What if you have the other scenario where the contribution is less than the pension expense? Then that is increasing the obligation. So this is a form of borrowing. This exact same concept is covered in example 6 in the curriculum. The numbers are a little more complicated, but I want you to do this example, and then we'll make a video available explaining this example. Now we come to the third and final section of this reading, which is fairly straightforward. We move from pension-based scenarios to share-based compensation. Share-based compensation is intended to align incentives of management and owners. What do owners want? To maximize the value of the firm. And you've seen this in corporate finance as your agency problem. What does management want? Higher salaries, more perks, etc. So there is a conflict. To minimize that conflict, one strategy is to say, look, management, you get this share-based compensation. How is this treated? From an accounting perspective, any share-based compensation, be it stock grants or stock options, these need to be treated as an expense, even though when a company issues stock options, there is no explicit cash outflow. Based on both IFRS and US GAAP, you need to come up with the fair value. If you are giving stock options, you use models such as Black-Scholes or the binomial model and come up with the value of the options, and that needs to be shown as an expense. And then whatever a company is doing needs to be disclosed. So the nature and extent of share-based compensation needs to be disclosed in footnotes. Any impact on financial statements needs to be disclosed in the footnotes. The theory is that share-based compensation will align incentives, but this doesn't always happen. There are some disadvantages of share-based compensation. One is that employees may have limited influence over the market value of a company. Even though you have shares, you are the senior executive, but the overall market goes down. Not really anything that the senior executives can do about that. Another interesting and tricky one is that increased ownership may make managers more risk averse or less risk averse. Now, this might seem contradictory, but let's take a situation where you are management and you have received options. If you recall from level 1 and something you will see at level 2, how do you make money with options? You make money with options if the stock price exceeds the exercise price. It's a one-sided payoff. If the stock price goes up, you make money equal to the difference. If the stock price goes down, then you don't lose anything based on the option. So let's say that your options are out of the money. The stock price is below the exercise price. You have an incentive in this scenario to take extra risk, because if your strategy fails, you don't lose anything. If your strategy works, then you can make a lot of money. So it is possible that with such an incentive scheme, you take more risk than is optimum for the particular scenario that you are in. Is this good for the owners? No. Is it good for management? Yeah. So the incentives are not quite aligned. What if you are already in the money, but the vesting period is not over? You still need to work for 2 more years. Now, what might your strategy be? If you are in the money, then you might say, okay, let me just play a very safe strategy so that I know that after 2 years, I can exercise my options and make money. If you take an extra risky strategy here, then the risk is that your strategy might backfire. Even if you take a normal risk project, which is what you're supposed to do, obviously the value might come down and your options will expire worthless. So hopefully this makes more sense. Another issue with share-based compensation, especially if it is options and so on, is dilution. What is happening to the number of shares outstanding? It's increasing, so the EPS gets diluted. This section actually also covers two types of share-based compensation: stock grants and stock options, which I've already started talking about. And then there is a brief section on other types of share-based compensation. First, we'll talk about stock grants. Within stock grants, there are multiple subcategories, but the basic idea with a stock grant is a company actually grants or gives stock to an employee as opposed to stock options. There isn't too much over here, just learn these categories. They might be outright grants or restricted grants or performance shares. An outright grant means that a company just says, okay, here are the shares. So you are now a shareholder. This is expensed or reported based on fair value, and the compensation expense is allocated over a reasonable service period. What's an issue over here? You might get the stock as an employee and sell it, and then the incentives are not aligned. Restricted grants, shares have to be returned if certain conditions are not met. So this is a little bit better. Expenses are reported against fair value. This fair value term you'll see across the board, and this other bullet point you'll also see across the board, where compensation expense is allocated over the relevant service period. And then with performance shares, here the compensation is determined by performance other than change in share price. Then we come to stock options. These are options that are given to employees by the company, again reported at fair value. Accounting rules require that certain models be used for valuation, and the two most popular models are Black-Scholes and the binomial option pricing model. This is very testable. When you use these models, you need to make certain assumptions and you feed some data. So there is a model which is giving you the option price. Let's say that the options are like call options. So you feed some input into the model, and the model will give the option price, which is then shown as an expense because the company is giving employees options, what cost to report. What are the inputs and assumptions? You need to input the stock price, the exercise price, volatility, estimated life of each award, estimated dividend yield, risk-free rate. Now, do these assumptions impact the value of the options? Obviously, there is an impact. This is something you'll see in detail when we do derivatives later, but you've touched on this at level 1. So I'll just give you the facts over here, which you should remember because you'll see questions based on this material. And then later on in derivatives, this will become clear. Obviously, there is an assumption about the volatility of the underlying asset. If you assume a relatively high volatility, what does that do to the value of the call option? It increases the value. What does that do to the expense? It increases the expense. So if a company wants to show a lower expense, all it needs to do is slightly reduce the assumption about volatility. And that is extremely hard to catch. How do you argue against a slight reduction in assumed volatility? So this is an easy way to manipulate earnings. Estimated life of each award. The next one actually that is important is the estimated dividend yield. If the dividend yield is high, then the value of the call option becomes lower. If you are really careful about studying level 1, you'd know this, but we didn't spend too much time on this at level 1. Level 2, this is extremely critical. So now just take it as a given. So obviously a company needs to make assumptions about dividend yields. Higher the dividend yield, lower the value of the call option. And higher the interest rate, higher the value of a call option. Again, these relationships are given and they can be used to manipulate the expense that is reported. You need to recognize that with stock options, there are several important dates. There is the grant date when the option is granted. Vesting date. This is the date where employee can first exercise the option. Obviously, if a company gives an employee an option, there will be a period where the company says work for 4 years and then you can exercise. And as before, the compensation expense is allocated over the service period. The final subsegment, this is not really explicitly mentioned in the learning objectives, but it's in the curriculum, so I'll spend a minute. Both stock grants and stock options have the potential to dilute EPS. So some companies have come up with the stock appreciation rights, where companies compensate employees based on increase in share price. So shares or options are not given, but a compensation is tied to the share price. The advantage is that potential risk aversion is limited, or the potential to take extra risk might be limited. The shareholder ownership is not diluted. All right. As before, these are valued at fair value and allocated over the service period. This is a theme across the board. The negative here is that they require a current period cash outflow. So if you've agreed on a certain formula, then the company needs to actually make that cash payment. Let us now quickly summarize all the important points from this reading. What are the different types of post-employment benefits? We talked about the defined contribution plans, which are very straightforward. The company simply makes a certain contribution and expenses it. Then there was the defined benefit plans, which took up most of this reading. Here the benefit is defined, so the risk is being taken by the company. And then you have other post-employment benefits, which are treated a lot like defined benefit plans. Here again, the benefit is defined, so the company is taking on the risk. Then we talked about the pension obligation, which is reported on the balance sheet. The number reported is called the funding status or the funded status. Here you look at the pension obligation, the fair value of the plan assets, and then you look at the difference. If you have pension obligation greater than plan asset, then you have an underfunded plan. If the plan asset is greater than pension obligation, then you have an overfunded status. The net number is reported either as a net liability or net asset on the balance sheet, and then in the footnotes there is additional disclosures. You need to know how to calculate the pension cost, and we talked about a very simple relationship where we look at the net obligation at the start of the period, the net obligation at the end of the period, and then adjust based on the company contributions. Also, you need to recognize the different components. Under IFRS, we had three components: the service cost, then there was the interest expense or income, and then there was the other remeasurements. So you might get an exam question where you are given these numbers and the company contribution. You should be able to start with the net obligation at the beginning of the period, and given these four numbers, you should be able to come up with the obligation at the end. So of all these numbers, one might be missing, and you might need to find that missing one. What is the impact of assumptions on pension obligation and cost? There is a table I showed you where we talked about the most important assumptions and then other assumptions as well. The most important assumptions have to do with the discount rate. A higher discount rate obviously reduces the obligation. What about other assumptions? So the compensation increases at a certain rate. You can make a change in assumption about that rate. And then in the US GAAP context, an important assumption is the expected return on plan assets. So you need to know the impact of all those assumptions. This in the recording also. Here, a general point to recognize is when the curriculum uses the term cost, they use cost in a very broad sense, which includes the impact on the income statement or the P&L as well as OCI. You need to be careful about scenarios where the curriculum is only talking about the income statement. For example, under US GAAP, the expected return on plan assets only hits the income statement. So be careful about that terminology. What are some important adjustments? One had to do with operating and non-operating income. Remember that when you have a certain pension related cost, that pension cost has different components. Only the service cost is really a operating cost. But the way financial reporting works, all the costs are shown as operating. So you need to pull out the non-operating components. And what are the non-operating components? The interest expense, for example, would be non-operating. Then we also talked about cash flow adjustments. In standard financial reporting, any contribution made by an employer is shown as a operating cash flow. But as we discussed, if the contribution made is different from the cost, then the amount that exceeds the cost is really a financing cash flow. And finally, we talked about share-based compensation. Here, the most important points are that there are assumptions made in coming up with the cost of share-based compensation, and changes in those assumptions will obviously impact the cost. Higher volatility assumption will mean that the cost would be higher. If a company wants to manipulate earnings and show higher earnings, it can reduce the assumption about volatility, which would reduce the cost and make earnings look better. So that is it in terms of this reading. As always, I want you to do the curriculum summary, review the learning objectives in the curriculum, do the examples. I think they are good. Sometimes they get long-winded, so if you don't have much time, at least read through them. But if you have time, then do try to work through them. Practice problems are critical, so do these from the curriculum, and then also try to do practice problems from other sources. That is it.